Hi, good morning, students. In last class, we were discussing about financial accounting process. In that, we started with a system of accounting. Actually, in accounting, there are two systems that are popularly called as English system of accounting and American system of accounting. American system of accounting, also called as this American system of accounting, is also called as US system of accounting, and English system of accounting is also called as British system of accounting. So there are two kinds of system of accounting. One is US system of accounting and American system of accounting. So US system of accounting and US system of accounting and English system of accounting. So we all Indians in India, we are following the first one. We are following the first one, that is English system of accounting, and in many other countries they are following American system of accounting. So under this English system of accounting, there are three kinds of accounts, or three type of accounting model, or classification of accounts are done in three types. Under American system of accounting, here under American system of accounting, the classification of account is made, the classification is made with five type of transaction, five classifications. So we'll in next slide we'll see about that. This is a type of account. We already discussed regarding this, just I'm recalling all these topics. Types of account. Under English system of accounting, there are three types of account. There are three types of account. One is personal, then personal account, then real account, and nominal account. So this personal account deals with personal account. This personal account deals with persons, individual, or any name of the individual, or any bank, any business organization. For example, Mr. Ratesh's account, or Mr. um, Praful's account, or Mr. Shashikumar's account, or Vijaya Bank account, Canara Bank account, or for example, uh, Amazon Company Limited account. So this all are comes under personal account. These are the examples for personal account. So personal always represent one individual person, personal, related to person, one individual person. For example, it may be a one person, one business, or any bank related to that. Then the second one is a real account. This real account deals with the properties. So any kind of properties, goods, material, machinery, building, land, furnitures, cash, all comes under real account. So real account deals with assets. So assets are in simple terms. So because the students those are from non-commerce background, they need to understand what is our assets first. So in simple terms, assets are properties. So property, that may be a furniture, land, building, cash. Cash is also a property for us. So this all are related to assets. So asset is directly related to real account. So real account deals with assets or properties. Then the last one is third type of account. Third type of account, that is nominal account. So nominal account is all related to all expenses and incomes. All related to all expenses and income. Here just I mentioned relates to expenses and also income, but the income word is missing here. Related to expenses and incomes. For example, paid electricity bill. So for you're running one business, and for your business you need to pay electricity bill. So that electricity bill expenses, or stationary expenses, or many kind of expenses will be there in our business. That all kind of expenses. For example, one more expenses like if you pay any kind of commission to your friend or salesman, that is also expense for your business. So that comes under nominal account. And one more example, that may be a income. So if you receive any bank interest or commission received from your friend or any other person, any outsiders, paid any kind of commission, or if you receive any kind of income, that all comes under nominal account. So under this English system of accounting, there are three. Under this English system of accounting, there are three categories, three classification. That first classification is personal account, second classification is real account, and third is nominal account. Total three. So personal account deals with the individual. It may be a individual person or business or bank. Then real account. This real account deals with real account deals with real account deals with a property or asset like building, land, furniture, cash, etc. Then nominal account. This nominal account deals with expenses as well as income, both expenses and income. Then we'll move on to the next slide. Here, American system of accounting. American system of accounting deals with the five type model. It means it's American system of accounting. Under classification, it is classified into five type of accounts. Five type of accounts that are assets, liabilities, assets, liabilities, capital, expenses, income. So assets means property. Then liabilities are responsibilities. Capital, so that is money or amount invested by owner. Then expenses, you all know about what do you mean by expenses, any amount spent for your business. Then income, any amount which you received as a earnings, that are income. So based on these classifications, the American system of accounting, American uh, accounting approach is classified. Then we'll move on to the next slide, that is golden rule of accounting. So this golden rules of accounting comes under English system of accounting. English system, that is British. So here you can see British system of accounting, personal, real and nominal. Personal, real and nominal, golden rules. This English system of accounting, the popular rules are also popularly called as golden rules of accounting. Under this golden rules of accounting, golden rules of accounting, personal, real and nominal. So here personal, real and nominal, personal account, real account and nominal account. So these three are having their own, each type of account has their own accounting rule. So that rule are typed here. You can go through this rule. So I'll just highlight this all. So this is rule for personal account. Rule for personal account, that is debit the receiver, credit the giver. For example, you are a person, you're running one business. If you receive anything, if you receive any properties, if you receive any cash in your business, when you're doing the transaction, when you're doing the business activity, then that receiver, the person who received that, for example, you received cash, that received cash, that cash, I'm specifically stressing on cash, that cash you received, that cash will be debit. And on the opposite side, if someone, it means other side, other person will receive that or other person will give that. So if you are receiving, normally other person will give that, give money, or it may be he transfer any kind of properties like furniture, many other things. So one, the person who is giving and person who is receiving, the person who is receiver, the person is considered as receiver, will be treated as, is treated as debit. His name should be his name should come under debit. The person who is giving, the person who is giving, the his name should come under credit. So debit and credit, already in the previous classes I mentioned about the two aspects of transaction or two aspects of account. Every business transaction has two aspects. Every business transaction has two aspects. That two aspects are, one is debit, another one is credit. So debit and credit, every transaction has two aspects. So for example, in your business, you paid cash, so you are giving cash. So your name, when you are giving cash, you need to be so considered as a creditor because you are paying cash. If you received cash, another example, receiving cash, you received cash of 5,000 rupees. So here you are receiving money, then you need to be considered as debit. Like that the personal account goes. Then real account. So under this real account, this real account deals with properties. Already I mentioned about deals with property. It is assets. So here debit, the rule is debit what comes in, credit what goes out. Debit what comes in and credit what goes out from your business. So debit what comes in. You are running a business. You are running a business. You received property, any kind of property. For example, you purchased one machinery. So you need a machinery to business. You purchased one machinery. That machinery is also one property, one asset. When you're receiving that, when you're purchasing that, that machinery will comes to your business. So in such cases, you need to debit that machinery. So machinery will be debit. So debit what comes to your business, debit what comes into your business, and from the business what is going out, that you need to identify. So normally I'll take the same example. Purchased machinery of rupees 10,000. That's just a small example. Purchased machinery at worth rupees 10,000. Now how we will purchase? While purchasing I paid cash. So cash is there and machinery both are there, cash and machinery. So in this example both cash and machinery. So here when you're paying cash, and one hand you are paying cash, on the other hand you are receiving machinery, both are there. Okay, so here out of these two, this is cash, right hand side always will give cash in right hand side cash, and on the other hand machinery when we receive machinery. So out of these two, apply this rule. Debit what comes in, credit what goes out. Now what is coming to your business, what is going out from your business? Normally this rule is applicable here. See, debit what comes in, what is coming here. So this is going out and this is coming here. So always machinery is coming in, comes in. So machinery need to be debited, and on the other hand, for purchasing the machinery, what we are doing, what we are paying, we are paying cash. So cash need to be cash need to be credited. So cash is going out from the business, cash is going out from the business. So every transaction has two aspects, cash and machinery here in this example. So cash is coming, so cash is this one, and machinery. So machinery is coming in, so that is debit what comes in. Machinery you need to debit it, and credit, so what is going out from your business, that is cash you need to credit it. Like that you need to segregate the transaction. Then you need to analyze what need to be debited, what need to be credited. Then we'll move on to the third rule. The third rule is nominal account. So this nominal account here, the rule is like this: all expenses, any kind of expenses and losses for your business, if you pay electricity bill, and if any kind of expenses, losses, printing, if you pay 10 rupees for printing, if you purchased one pen of 50 rupees, so that all are expenses for you, that all kind of expenses and losses, if it is any loss, that everything need to be debited, everything loss always. So in this both two hands we'll consider left hand as an left hand is losses, because always we'll use right hand for receiving money. So let's compare that right hand for income, left hand for expenses. So income and expenses, loss, income and losses. So if anything incurred loss, if anything happened, losses or expenses, then expenses need to be debited first. This expenses need to be debited. If income, so this incomes, for example bank, when you deposit money in your bank account, bank will give interest for you, that interest is income for you, that is credit. Always income need to be credited and expenses need to be expenses. So that's why I'm showing like this: expenses or losses need to be debited. So expenses and income, so expenses should be debit and income should be credit. Like this you need to apply the rule. Every transaction has two aspects, one is debit and credit. In each type of transaction you should identify what is debit and what is credit. How we will identify? By applying this all three rules. This all three rules are called as golden rules of accounting. So one is personal account rule, real account rule, and nominal account rule. So personal account rule, debit the receiver, credit the giver. So the here also debit and credit. So two. In the real account rule, debit what comes in, credit what goes out. Here also two. One is debit, another one is credit. Then nominal account, debit and credit. Debit all expenses and losses, credit all incomes and gains. So here also have we have two aspects. So this is golden rule of accounting. Golden rule of accounting. Then we'll move on to the next slide. So I thought of explaining this with the example. I thought of explaining with the example of one transaction and how we'll consider this transaction, find a result. For example, this is one transaction. Here there are 5 points. 5 points indicates the steps. First, assume that you don't know anything. Just in one question paper or in one person told you transaction. The transaction is you are running business and you paid cash to Mr. Kiran. Kiran is outsider. You are paying cash to Kiran. So this is, I'm highlighting this. This is one question or one transaction. You need to, out of this transaction, you need to identify what need to be debited and what need to be credited. That is your task. You need to identify. How to identify that? To identify that, what we need these rules. We need these rules. That rule are called as golden rules. We need to apply personal, real, or nominal. Out of these three rules, we need to apply rules, and which is suitable here, we need to identify that. For that we need to classify that. How we will classify? Blindly we can't classify. We need some basis. What are those bases? That basis are this personal, real, and nominal classification of account. So already I mentioned in the previous slides, that is personal under personal, name of one individual. If it is name of any one person, that will comes under personal account. If name of any business or any bank, any organization, that comes under personal. Then if any bank's name, for example SBI, HDFC, Canara Bank, that comes under personal account. So I mentioned these examples. Then real account. Under real account, already in this previous slide I mentioned about property. Real account is property. So we'll go here. Real account. For this real account, there are many examples for that. Here I mentioned few examples. Land account, land, building, furniture, cash, if you purchase any vehicle, car, that all are examples for real account. So comes under real account. Then nominal account. Nominal account, already I mentioned that here all expenses and incomes. Any kind of expense will come here. Interest received will come here. Then if you paid a power bill, electricity bill, or any kind of income, bank interest, commission, any kind of income comes under nominal account. Out of these three, you should identify in your transaction, this first one, point number one, in this transaction, this two aspects, where it will come, where these two aspects will come. In this transaction, this is just your transaction starts here. You paid cash. This is your transaction. I'll highlight in the red color. This is your main transaction in paid cash to Kiran. So in this paid cash to Kiran, you need to identify two aspects. Only four words are there. Out of this, main two core words are cash and Kiran. So cash is one aspect, Kiran is one aspect. Cash and Kiran. So by using this second point, identify where cash will come, where Kiran will come. So first we'll take the cash, the term cash. So see here, any item cash, no, cash is not there in personal account. So you can see this, cash is not there in personal account. Then check whether real account, in the real account, is there any cash item? Land, building, cash. Yes, here cash is there. So what we'll do, first for your understanding purpose, I'll highlight this in the red one, or else which should be better. Okay, I'll highlight with red one. So by that it will be easy for you to understand. So cash, we identified first aspect, cash. Then what else? So then the next one is Kiran. Where Kiran will come? Check personal account, real account, nominal account. So I'll go to nominal account. Expenses received. No, nominal account. In the nominal account is not there. Why? Because Kiran is individual person's name. So in nominal account it will not come. Then real account, whether it will come. So real account, all are related to property, but Kiran is individual. Then definitely it will comes in personal account. So personal account. In this personal account, see name, business name, individual name, business name, or bank. So Kiran is not a business name. Kiran is not any bank. So Kiran is a person, name of one individual, name of the person. I'll type name of person. Name of person. Yes, Kiran is a name of person. So it will come here. I'll highlight this. So by that it will be easy for you to understand. Kiran is person. Now one comes in personal, another one two aspect. I told two aspect. Out of two aspect, first one comes in personal, then one more comes in cash. Two aspect we identify. Then out of these two aspect, what we need to do? So go to the third step. That third step is apply the rule. So this rule, I mentioned these rules. I explained about this rule. Apply these rules. First, we already identified personal and real. Go to this rule. What is a personal account rule? Debit the receiver, credit the giver. That is the rule of personal account. Write this personal account rule. Debit the receiver, credit the giver. Then real account rule. Write the real account rule, because real account here it will come cash. Real account. What is the rule of real account? Debit what comes in, credit what goes out. So write this rule. I've written already to save time. Then what happens? What you need to do? What happens in this? What you need to do? So here, apply the rule. Debit the receiver, credit the giver. Debit the receiver. So here, who is receiver and who is giver? So who is receiver? Who is receiving the money? The actual transaction is paid cash to Kiran. Who is receiving the money? Who is receiving the money? Kiran is receiving the money. Debit the receiver, credit the giver. So as per this rule, debit the receiver. Who is receiving the money? Kiran is receiving the money. So here, Mr. Kiran. So you need to tell first, you need to identify whether Mr. Kiran's name will come in debit or credit. So he's not giving the money, it will not, his name will not come in credit. Definitely it will come in debit. Why? Because he is receiving the money. So Mr. Kiran, I'll highlight his name in that answer in green color. Why? Because we got the answer. So debit, in debit, Mr. Kiran will come. Then go to the fourth step. Actually, if you understand everything, no need to go for the fourth step, because in that accounting transaction, out of two aspect, if one aspect is debit, automatically another aspect should be credit. But I'll directly going to that stage. If you understand everything, then you can move directly. But first, in the first class, what you need to do, first apply both rules. Then when you practiced, you can blindly, if you identified one, directly you can move on to the final transaction. So apply the real account rule. Debit what comes in, credit what goes out. Out of these two, debit what comes in, credit what goes out. So here, debit what comes in, credit what goes out. So here, real account cash. So cash is coming into your business or going out from the business. You need to identify. Debit cash is coming to your business or going out from the business. So cash paid cash to Kiran. So cash is going out or coming in. So cash is going out, paid cash. So cash is going out from your business. So debit what comes in, credit what goes out. So cash will come here or here. Cash will come in debit or credit. We need to identify. Already we applied the rule. As per our rule, cash is going out. So it means as per the real account rule, debit what comes in, credit what goes out. What is going out? Cash is going out. So cash account, cash will come under credit. So cash, I'll highlight it in the green color. By that it is easy for you to understand. So these two we already identified, which is debit and which is credit. Now as per the accounting techniques, as per the accounting concepts, we need to pass the journal entry for this transaction, for this question. How to pass? So that passing the transaction, there are proper font, like debit, credit, columns, then particular column, everything. I'll not touch that part. Just we'll understand how to classify this, how to uh, reach the final stage. Then when you understand this, I'll explain with that. The result is, first we identify two aspects. I'll type this. One is Kiran. So Kiran, Mr. Kiran, I'll type Mr. Kiran, then cash is 2. Out of this 2, which is debit? I will write debit and credit. What is debit? I'll use the short forms. Debit, DR for debit, and CR for credit. Don't tell that doctor DR. It is in the accounting term. DR means debit, and don't call DR also. It is debit. Okay. So Kiran is debit and cash is credit. So like this, we need to classify. Kiran already identified debit, cash is credit. So that is the way to classify the transaction, to identify two aspects and pass the journal entry by using the golden rule of accounting. That golden rules of accounting are personal, real, and nominal. Each type of account has their own rule, that is debit. For personal, one rule, real another rule, and nominal one more rule. There are 3 kinds of rules. You need to apply each rule for every transaction to identify one business transaction, whether it will come in debit or credit, which one will come in debit and which one will come in credit. So that is the way to identify and to classify the accounting transaction. Okay. By this, I'll conclude the class. Thank you for listening. Thank you for watching the video.